SF Desk Brief, Live Newsroom. Friday, January 30th, 2026. Opening. Good afternoon. This is the Silver Forecast Desk Brief. Earlier today, silver and gold experienced one of the most violent intraday reversals in modern market history. Gold dropped hundreds of dollars in minutes. Silver fell sharply and fast. This desk brief explains what actually happened, what did not happen, and what matters next. What happened today? Today's move was not a surprise breakout failure. It was a liquidity event. Stops were triggered. Algorithmic selling accelerated. Human traders stepped back. Markets became untradeable. Even professional floor traders said price discovery disappeared. That's not opinion. That's admission from the trading floor. This was forced selling into thin markets, not orderly exit by long-term holders. What did not happen? Despite the size of the drop, the system did not do the three things required to reset pressure. Physical demand did not step away. Exchange inventories did not rebuild. Volatility did not cool. That matters more than the price drop itself. Physical silver check. Let's start with physical silver. Even after the sell-off, Shanghai silver inventories declined again today, falling by roughly 27 metric tons. On comex, eligible silver was withdrawn again. Registered was not rebuilt. No reclassification surge appeared. When silver falls sharply and physical buyers do not retreat, the market is not relieving pressure. It is compressing it underneath price. Why this was not absorption? Absorption looks calm. Price eases. Volatility fades. Inventory withdrawals slow. Today looked nothing like that. This was stress being expressed, not stress being resolved. That's why violent down moves in unstable markets often fail to finish the process. They shock participants, but they don't change the underlying imbalance. Treasuries and the safety valve. Treasuries did catch a bid today. That's normal during forced liquidation. But this was not a decisive shift into safety. Bond buying was reactive, not confident. If the system had truly stabilized, we would expect sustained bond demand, calm volatility, cooling physical demand. We did not get that combination. Geopolitical backdrop. None of the underlying geopolitical risks were resolved today. Policy uncertainty remains. Military tensions remain. Currency confidence remains fragile. Paper selling does not eliminate those risks. It only tests whether the system can absorb them. So far, absorption has failed. What today actually confirmed? Yesterday, the market was forced to choose. Today confirmed how unstable control really is. This was not the end of the silver move. It was a stress test of the system. And the system showed strain. Scenarios and probabilities. Desk brief standard. Here is the current probability framework. Scenario 1, partial reset. Approximately 35%. Silver pulls back further toward the 100 level. Volatility cools. Physical premiums compress. Inventory withdrawals slow. This would represent a temporary reset, not a thesis failure. Scenario 2, failed reset/pressure persistence, approximately 55%. Volatility remains elevated. Physical silver continues leaving warehouses. Comex fails to rebuild inventory. In this scenario, pullbacks do not resolve pressure, they relocate it, and price instability persists. Wildcard scenario, approximately 10%. External shock forces temporary calm across all risk assets. Short-lived relief before pressure reappears. Bottom line. Today's sell-off did not break the silver thesis. It exposed the stress inside the system. As long as physical silver continues to leave warehouses and volatility remains high, price instability is not a warning sign. It is the mechanism.